Good morning and welcome, good afternoon, good evening to this RVW presentation. We're deeply honored to have as our keynote presenter today Professor Jeremy Siegel, Professor Emeritus of the Wharton School. Although, as he knows, our feeling about him is he's not emeritus to RVW, he may be emeritus to Wharton. It's a great pleasure to have one of the seminal thinkers and one of the most influential people in the whole investment world, and specifically to the RVW team. In fact, I've been a keen follower and a student of the professors for over 25 years. When I first heard him speak, it was a life-changing experience for me because up until then, I'd lived in the world of stock picking, market timing, economic forecasts, and that whole world of predictions that really has no place in sophisticated wealth planning. And as I always tell people, the idea is to prepare, not to plan. Is to prepare, not to predict. And so that's what we do is we prepare. And part of the preparation is lining up the right people, the right thinking, and the right approaches to wealth management and to risk containment. It's reassuring to know that the original findings of the seminal work put out by Professor Siegel all those years ago, called Stocks for the Long Run, which has reprinted for thousands of times around the world. It's now in its sixth edition, and the wisdom that comes out of the sixth edition, I will tell you, totally validates everything that came out before. In other words, when you're dealing with evergreen wealth principles, they shouldn't change with time. And the fact that the findings of the last period supports the very early findings of Professor Siegel and his research team is tremendously supportive of everything we do. In fact, hardly a portfolio at RVW has been constructed that doesn't have one of the funds put out by the fund family inspired by Professor Siegel's wisdom, called WisdomTree, believe it or not. And we're great fans of WisdomTree. It's a critical part of our typical portfolio because it's based on science, on data, and on fundamental economics rather than on thumbsucks and predictions, which almost always are unreliable. And in fact, RVW and WisdomTree are almost the same age. And we've grown together today to the point where RVW manages $1.5 billion of nest egg money for people who know that our steady hand on the tiller is because we guide the ship by the stars and not the prevailing winds. And one of the stars whose shining light guides us is that of Professor Siegel and the team at WisdomTree. So, with that, Professor, I'm deeply honored and humbled as your student and follower and admirer and client, because we do business with your company, to introduce you to many people around the world who are thirsting for knowledge, insight, and wisdom. And if it's okay with you, we'd like to use this opportunity and this special time with you to have you, first of all, take what I would call a 10,000-foot view of the economy, the macro trends, and then to maybe zoom into some specifics, maybe some little politics, if we're allowed to go there in terms of what's likely to happen, and maybe even looking at the Mag 7, the likelihood of that continuing its magnificence, and of course whatever you think is appropriate for people who are curious and concerned. And with that, thank you so much for being with us.
Well, Selwyn, what a wonderful introduction. And, I think back, I did the research for Stocks for the Long Run in the late 1980s, started writing in the early 90s. That got published in May of 1994. So we have over 30 years. It's interesting that the real return on stocks has been very much the same over the last 30 years as it was in the 200 years that had preceded it. And that was one of the theorems of the book was although stocks are the most volatile asset class in the short run, and it makes the news and everyone follows every little twist and turn. In the long run, its real returns, I mean, it's after inflation rate of returns, are actually the most stable of any asset class. And that we call that mean reversion. No other asset class actually has that degree of mean reversion as stocks do. So volatile in the short run, steady in the long run with real returns that are, still, in my opinion, 3% or 4% higher than bonds. If you are willing, and you should be willing, to hold it through its short-term volatility. Um, yeah, I'm going to do what you suggested. Try to take a big macro view and then drill down. I mean, this morning I was on CNBC at 7:30 and talking about what inflation might be, and then an hour later we got the inflation, what that means. But let's start again with a bigger picture on stocks. There's been a lot of discussion that stock prices are extremely high. The discussion that President Trump, under his term, is the highest in any presidency. Let's talk a little bit about that. First of all, I've written for many editions that I thought that the equilibrium price earnings ratio of the S&P 500 should be about 20 for the market. A lot of people are talking about 15 or 16, and I gave good reasons why it should be trending higher over time, and that we now reach 20. Now, you could then say, well, yes, but Professor Siegel, we're at 22 now times 12-month forward earnings. Got to be really careful on this. We really do have an extraordinarily bifurcated market. In the sense that if you will want to, let's use the term that everyone uses, and you even used, I think, the Mag 7 term, where the average PE of the stock is well in its 30s. Even if you take out Tesla, which is sort of an outlier because it's really, honestly, trading on either Musk's relationship with Trump or its autonomous driving and robotics rather than actual sales of the Tesla car. Even if you take the other six, you're in the 30s, low 30s, high 20s. If you take the other 493 stocks in the S&P 500, you're at 19 or less. And if you start going down towards the mid caps and away from the tech, because there's still a lot of tech that are there in those 493s, you're going down to 18, 17, 16, 15, and even lower. So I do not think the market is overvalued by any means. I think there's still great opportunities. Is the Mag 7 vulnerable? Of course it's vulnerable. The last 10 to 15 years, we've seen the greatest and longest appreciation of value stock, of growth stocks relative to value stocks in the 100-year history where we have data and analysis of individual stocks, which goes all the way back to the 1926 data, the Center for Research and Security Prices that was developed at the University of Chicago, which was my first teaching position. Actually, Pharma French, all that data really comes from 1926 to the present. And we've never seen a group of stocks, certainly never seen a group of stocks with capitalizations as high as they are, that have been able to continue to appreciate at PEs that are in so excess of the market. Now, people say, Dr. Siegel, are we in a bubble like 2000? And the answer is definitively no. I'm not saying we can't get there, and that's impossible to get there, but we are absolutely not there now. Now, what do I mean by that? Well, back in 2000 was the only real bearish lead op-ed that I ever wrote. The Wall Street Journal was called "Big Cap Tech Stocks Are a Sucker's Bet." I said, this is crazy. And why was that crazy? Because the PEs of those stocks were selling like 100 to 200 times earnings, way in excess of what we have today. Now, is it impossible for today to get as ebullient and effervescent as we saw in 2000? Possible. I don't think likely, but I certainly wouldn't rule it out. Markets do fluctuate. But, people say, oh, we're back in a 2000 bubble. That is wrong. That is wrong. Now, Do we know when the reign of the Mag 7 and similar stocks will end? And the answer is definitively no. I mean, Selwyn, you're absolutely right. To rely on forecasting is wrong, but to rely on good sense is always right. Nothing stays on top forever, right? We all remember 2000 when Cisco Systems was touted as the first $1 trillion stock when it was selling at $500 billion market capitalization. It would go to the moon. Well, today Cisco is selling for about the same price as it did 25 years ago. Terrible, not good. We all remember back in the 1960s when IBM was the only computer company that controlled 85% of computing capacity and made all the progress and all that, and nothing could challenge it. Well, IBM still exists. It's an okay company, but it's almost an also ran in terms of what has taken precedence over the last 10 to 15 years. So again, you look at history when things look invulnerable and eventually vulnerability came to the fore. Um, we have a very positive AI narrative going on right now and have for years. There's a few little cracks in that AI narrative. I mean, it first came a month ago with DeepSeek. The second might have just come 2 days ago with the Chinese auto manufacturer BYD saying, you know what, we're putting out autonomous cars like Tesla, and you've seen what's happened to Tesla stock over the last 2 days. So I mean, nothing is invulnerable, but I'm not going to call the end. And a lot of them are great stocks, and a lot of them, such as Meta and others, who haven't really put a lot of resources in AI, may actually benefit from being able to get AI at a much cheaper price. So, and not everyone is going to be affected equally in any sort of rotation. Nonetheless, one of the best things about taking a value tilt, even though we have to admit it hasn't performed as well as the S&P over the last 5-10 years, virtually no manager has been able to actually perform better than that index. There are some, but is the fact that you don't need a lot of growth. I mean, when you're selling at 15, 16 times earnings, which is most moderate size companies today, you really don't need much growth. Just the return on capital will give you a 6-7% real return on your assets there. So the rest of them, the Mag 7 is a unique situation. No one knows when that might end. The rest of the market is not overvalued and still offering values and returns that may be a bit lower than the 6.9% that I get for 225 years. But I would certainly say in the 6% after inflation rate of return. All right, let's talk about bonds and interest rates. I was one of the very few people in September when they lowered by 50 basis points. I said long-term bond interest rates are going up. And it wasn't necessarily there was going to be more inflation. I said the Fed is really preempting any possibility of recession and going to stimulate growth, and that was good. We're getting towards a more normal, what I call term structure, which is long rates above short-term interest rates. We were in an inverted situation for 2.5 years. That's abnormal. We have the 10-year, today jumping to 465. We have a Fed funds of 433. Now, the average difference actually is well over 100 basis points, and we're not there yet. That's why I am not at all optimistic about what, bondholders. I think real returns and I think nominal returns, we could see 5 to 5.5% on the 10-year by the end of this year. And by the way, those people who Wall Street Journal had an article and several others, an article and talked about negative equity risk premiums are completely wrong. They're comparing nominal bonds with the forward-looking earnings yield on stocks. And you're comparing apples and oranges. Stocks are real assets as I've written so many times, bonds are not. If you want to compare apples to apples, you look at TIPS prices. The 10-year TIPS is 2.1%. The forward-looking earnings yield on the U.S. stock market is 4.5%, and that's with Mag 7. X Mag 7, it's 5.5% to 6. So no inversion. We did have inversion in 2000, just to give you an example of when things can get really overvalued. So again, that summarizes what I think on the stock market. I don't think bonds are the place to be. I do understand the short-term diversification. If you're, really worried, geopolitical events, recession, something like that, bonds will perform better, but that's very short term. In the long run, they're definitely going to lag. Let me get a little bit more. I'm focused and a little bit. Let's take our lens and push it in a little bit here. I've been saying for weeks, if not months, that there will be little or no interest rate cuts this year. The market now is pricing in barely one, and you have to know that the pricing in effect on Fed funds futures is an underestimate of what the market thinks. There may be none. If there is one, it's a recession or a big slowdown. Now let's focus in a little bit better. We didn't get not a good report in January. I said at 7:30 I didn't think it was going to be good. It came in a little worse than I expected. Jolted that bond market. The truth of the matter is we're going to get another inflation whole report. First of all, PPI tomorrow. We're going to CPI and PPI again before the March 19th meeting. There were a lot of data. What I said at 7:30 this morning, and I'm going to say it to you, is right now I think the tariff situation is more important to the market than this inflation data. Inflation is important, to be sure. But if you want to talk about a worry, it's the tariffs, the uncertainty, and the potential of retaliation. I think that's the only thing that's really keeping. I mean, if Trump would come out and say, "Hey, we got an announcement with Canada and Mexico. We're not going to put anything on in a month. We're working with the others. They're improving their trade practices enough for us to get it in," I think you'd see a 10% jump in the stock market. I think that uncertainty is keeping the lid on because the other parts of the Trump scenario, policy scenario, are really quite favorable. But I think that the tariff uncertainty is overhanging the market in the short run, and it's hard for me to see it. I did say that I wouldn't be surprised to see a correction this year. That's a 10% drop in the stock market. Any little thing can go wrong and bring the market down. Geopolitical disappointment, the tariffs, if they're really imposed on a big way, I think would bring about a correction, in my opinion. But we got to remember one thing, and I've said this ever since, even before Trump was elected. There is no president in history that has measured his performance with the U.S. stock market as closely as Donald Trump. As a result, he will not do anything that will permanently harm that stock market. Now, that doesn't mean the stock market can't go down, because he doesn't control the world. And, we are in a capitalist society. There's normally going to be a business cycle. I'm not calling any recession. I see no signs of one. I'm just saying there could be geopolitical events that are out of his control. All sorts of things can happen. Does not mean he can guarantee the market will go up. But it is comforting to know that even though he probably does see some negatives when he announces those tariffs, I don't think he would want to keep them on long enough that would damage the stock market. He would take them off or make some sort of deal. And that's a positive factor, in my opinion, on the stock market during the Trump's term. Again, it doesn't guarantee that they're going to be good markets, because I think that the rest of the world, not me, attributes way too much to the party in power or the president on what happens to the stock market. Now, it doesn't mean that bad policy can't hurt, or good policy doesn't help. But the movement of stock market has a lot to do with sentiment and worldly things that are outside the control of Congress or the presidency, and you have to accept that as part of what we, as a free market that we have had for since this our founding nearly 250 years ago. Um, so with that, I know there's a lot of other questions you might have, and so when would love for you to ask me anything that I didn't
Thank you.
cover that you're interested in, or
Thank you.
simply embellish on what I said.
Yeah, thank you very much. Well, I'd like to ask you whether it's possible that Sarbanes-Oxley and the more stringent audit and accounting procedures make equities less risky because earnings are better quality. And if that's the case, and there is certainly, I think, as a CPA, I think that would that be a reason to have more highly priced stocks than we used to before? Or you not see that as a major factor?
I don't see that as a major. There are pluses and minuses to Sarbanes-Oxley.
Uh-huh.
First of all, what I don't like is FASB. It's that I mean, Warren Buffett himself has said he thinks that reported earnings, or FASB earnings, the Financial Accounting Standing Board earnings, have turned ridiculous, and that he looks at operating earnings, which the street does. The official reported earnings contain capital gains and losses, which they should not,
Yeah.
and so they're more volatile. I think the major reason for the trend upward, if you want to know, is the fact that we have such a liquid market, where any individual can get the world market at 2, 3, 4, 5 basis points. That was impossible in the 19th century. In fact, in the first half of the 20th century, it was impossible. So, I mean, the transactions cost of trying to maintain a balanced portfolio back in, before a few decades ago, and index funds would have, eaten up, 50, 100, 150 basis points a year. So you're getting liquidity that you never got before, and you're getting lower costs that you never got before, and that would raise the price earnings ratio.
Thank you. That's excellent. And then, the 60-40 portfolio, 60% equities, 40% bonds, we've regarded that as dead a long time ago. I presume you share that view entirely.
Oh, yes. That's been an official view of WisdomTree from way even before the bond crash
Yeah.
of 22. You know, we look at 75-25. Now, different again. You will get some diversification short term for certain types of risks. And by the way, one where you do not get any diversification in your bonds is inflation risk. They turn out to be terrible diversifiers for that. So, but for other types of risk, if you're a person that is very sensitive to short-term fluctuations, then the bonds would help you. But if you got a longer-term outlook, the bonds are not going to help you, because they're not going to help you for inflation risks, and their real returns going forward are still far lower than what you can get in the stock market, and will be a big drag on your portfolio. So we went even way before, um, the bond crash, and we said, get out of bonds. Actually, right. I said back in 2020 that the 40-year bull market in bonds that started in 1980 and ended in 2020 was over, and it did, in
Professor,
fact,
we're
crash.
right at your side, and have been right beside you on that, on the whole thing. We view it the same way, and we view bonds as only where necessary, as a necessary kind of evil. Where they need it, they do a good job, but to have them simply because of a 60-40 ratio is absurd, particularly since many people have bond equivalents with other sources of steady income and stability. So yeah, 100% we're there. Can we just look at two other aspects of the market, and then I think we probably can wrap it up. The first one is small caps. Do
Yeah.
you even they've way underperformed
Yes.
recently, although the long-term history is
Yes.
really strong. Private equity, does that impact them at all? And do you think that the carried interest issues relative to private equity and other, are we seeing the best companies not going public for whatever reason? And the other thing about small caps is those that are really great become mid caps and they definitionally get out of the small cap space. So you're constantly losing the best ones. It's a problematic area. How do you see it?
Okay. So let me tell you, small firms are um, are very much subject more to interest costs set by the Fed than large firms. Now, the tech, they don't care about interest rate. I mean, it affects the valuation because it's a combination, but they don't finance by bonds at all. Small firms, inventories, and all the rest, they borrow at the Fed funds rate +1, +2, prime rates, LIBOR, so for all those. So what's happened, why they haven't participated in the Trump rally? I mean, yes, they like lower regulation. But remember, back in September, a lot of people were thinking that there were going to be 4, 6, 8 cuts, and we're going to get down on there. And then that's been, that's not happening, and that keeps that interest expense up, which the big caps don't have. So when I see it, like even today, I mean, you had a jump in yields. Small caps are underperforming. It's that because they finance. So it's not just the fact when interest rates go up that there's competition for everyone, large and small, against equities. But the profits of the small firms also get hit, which the profits of the big tech don't. So that's one reason. The fact that now what looked like a year ago 6, 8 cuts or more now is virtually gone. That prospect, I think, has hurt it. On the other, secondly, is that you know that the Mag 7 is really been, as I said at the very onset, um, um, unprecedented, that we've never seen the growth stocks, not only their performance do so much better than value, but also their earnings doing so much better. The Mag 7 by and large have they have brought home the bacon, as the expression goes. I mean, in contrast to 2000, where a lot of those companies were selling on a promise that they were, their margins would stay high and explode. These companies have brought unbelievable earnings growth. And, once you get out of Mag 7 and some of the tech related ones, you are in a value world. And the value is, they're not going to perform as well. Um, so then the Russell is not underperforming the value group of the moderate or even bigger stocks very much. It's that everyone has not been able to keep up with that Mag 7. And that's what I said, is that unprecedented run of 10, 15 years, really, and accelerated in the last year two, is one of the reasons why you get that lag. On the other hand, let me tell you an interesting principle. When I sometimes ask my students, what would you rather have, a 12 PE stock that has no growth, just keeps up with inflation, but no internal growth, but doesn't disappear, stays at 12, or the S&P 500? The answer is you rather have a 12 PE stock with no growth. Why? A 12 PE stock has over an 8% real return, which beats the S&P 500. So, I mean, you don't even need growth. Once you get down into the below, mid-teens to lower, you don't even need growth to do extremely well. But I mean, again, they haven't done that sort of it because they've moved their PE down from the 16, 17, 18 down to that. So they've seen a PE shrinkage. But at this level, once you get down into low teens, um, uh, you don't have to surprise on the upside. In fact, if you just keep up going, you're going to earn a good return. So, in a way, I'm looking forward at a lot of those that have underperformed and seeing in the next 5 to 10 years, I would not be surprised to see them being the top performers.
Thank you. And on international, any thoughts on going global?
Well, again, once the reason why international has underperformed is because international is a value world. You go outside the United States and look at the companies, and they're not doing that much worse than the value stocks in the U.S. But they can't beat the S&P, and they can't certainly beat the Mag 7 or the or the Russell 1000. I mean, because of the Mag and the others pulling that up. But there is no Mag outside the U.S. I mean, you have Taiwan Semiconductor, you have Nordisk, you have a couple companies that are that have something, but basically zero. So again, there outside the US, you're at 14-15 PE ratio, which is actually a 6.5 to 7% real return going forward with no growth, with moderate, very moderate growth. I mean, but they haven't been able to keep up. So again, I understand what's happened to them. It's the same thing that's what's happened to the value stocks, um, and it's the reason they've underperformed. No surprise. And the international situation is not that much different from the value situation if in the United States itself.
Fantastic. Well, that draws the presentation to a close. I thank you very much, first of all, to you, Professor, and to your great team at WisdomTree. Words cannot express our gratitude to you personally and to WisdomTree for everything you bring to us. It's a pleasure to do business with you, truly. And also to thank each and every one of you who took the time to join us. You will get a replay link if you want one. Just send in a request, forward it to your friends. The wisdom should be shared. Thank you very much. Be well, everybody. Enjoy the rest of winter. Thank you.
Thank you, Selwyn.